Hello and welcome to the Weekend Investing Daily Byte of 30th of July. An uneventful day today. The market again trying to come closer to 25,000, not really getting there. It's just like the batsmen in their 90s getting nervous. Nothing wrong in that. I mean, it can take its own sweet time to cross 25,000. But again, another part of the market made sure that the markets were buoyant. The markets remained, uh, near the 25,000 territory. Today, we will have a discussion on capital gains tax, whether it is fair, whether it is unfair, how capital gains tax is applied in other countries. There is a lot of backlash on the government for capital gains. Some of it is right, some of it may not be right. We'll have a discussion on that. But plus, first, please subscribe to the channel if you haven't, and you can click on the bell notification also. So as you see here, Nifty again very, very flat. Last two sessions, the closing price has not moved from the previous day. Yesterday also, it had gapped up, gone up, but again come off. And today the same thing has happened, 24,857 on two sessions. We have now tried to touch 25,000 but has fallen back. Nothing wrong in it. We've gone 800 points or 700 points on a trot in the last 3 4 sessions, and hence we are taking our own sweet time to consolidate there. Nifty Junior also hitting some resistance at this previous high, not really coming off, minus 0.1%, very much you can say uh, poised to make new highs in coming days here. Mid caps more robust, plus 0.48% at a new high, 21,750. No stopping here. Last five sessions in green, and small caps also, peaking out of that previous resistance, 0.82% up to 17,893. Now very close to 18,000 mark. So amazing, amazing run in the markets. Bank Nifty remaining, very, very iffy, 0.18%. Like yesterday, today's move was also sharp. So there were huge bouts of selling, almost two times, almost 800 points kind of selling came through. So there seems to be, some sellers at every bounce they are selling, but overall, the prices are not really collapsing. I mean, they are sticking there, but not yet being able to go up. Today's heat maps, you can see uh, power sector, NTPC, Power Grid, and energy stocks, BPCL, these were ruling the markets. Tata Motors also up 3.3%, Titan up 1.6%. But other than that, there wasn't much to talk about. HDFC Bank for a change was up 0.6%. Levers, ITC, Nestle, Britannia all down. So FMCG was the major uh, segment that was losing ground today. In Nifty Next 50, also several of these stocks that were running hard till a day or two back, ABB, Siemens, PNB, DMart, all were correcting today. Adani stocks, Adani and Sol was up 7%. Varun Beverages, after a spectacular result, collapsed 6%. So everything was already baked in, it seems. Godrej CP, United Spirits, HALBEL, Torrent Pharma, all losing ground. DLF managed to inch up a little bit more. Trent continuously goes up at plus 1.8% once again. Sectoral trends. Energy was the sector which led the market from the front today, from the very start. And there was talk about new orders for NTPC, Power Grid, and how the order book has been swelling for these companies, and new capacity addition is now the outlook why these stocks are running. Of course, that is a bit far away. Those capacities will come in in play 4 5 years down the line, but market is running ahead. Public sector enterprise stocks and energy stocks were the leadership pole position in the market today. In the last 1 month now, public sector enterprise stocks have gained 9%, and the last 12 months they're up by 115%. Energy stocks also up 66% in the last 12 months. So these have been doing well, and now again taking the lead position. FMCG, pharma and consumption, IT, all down. So this is gradually moving away from defensive again. So you can see that defensives are not in the front. So market is playing with the aggressive front foot stance. It is not in a defensive mode. It is not doing a I want a one run on every ball, but it wants to go ahead and kick some fours and sixes. So that's where the market is. In terms of energy index, this has now crossed convincingly above the election day high. So the index itself on energy is showing you good promise going forward. In the stock spotlight, PCBL is the stock which really ran up 10.76%. It had been in a huge consolidation phase since February, dropping from 350 rupees down to as low as 210, but it has come back up very, very smartly, hitting this resistance right now. And above that, if it goes, you will have a new chapter for PCBL starting. And for the long term chart of this stock, you can see it consolidated here from 2008 till almost 2017, a very, very difficult period. And then, the breakout came above 20 rupees, going to 125, again dropping to near 20 rupees. And then the last time the journey has started from 20 towards 331. So very, very volatile in terms of the moves. But since the last 24 years, it is a gradual going up kind of a stock. Capital gains tax, is it fair or unfair on you? Let's discuss the history of capital gains first. So, 1992, Manmohan Singh introduced indexation benefits for capital gains and a special tax rate of 20% for LTCG. So, in 1992, LTCG was 20%, STCG was slab rate, and dividends were taxed in the hands of shareholders at slab rate. That was the regime of 1992. Then in 1997, Mr. Chidambaram came in and he abolished the dividend tax in the hands of shareholders and said the company will pay dividend distribution tax. When dividends will be given out, companies will pay the tax and shareholders need not pay. LTCG was kept with 20% with indexation. So if you now, with today's context, see where LTCG stood. So LTCG today in real estate was 20% with indexation. Um, Earlier in the 90s, it was for stocks 20% with indexation. So that's where the context is coming that 20% with indexation was seen as a reasonable long-term capital gains on stocks, and of course, short-term capital gain was kept at slab rate, which in today's time, is kind of unimaginable for now. And dividends, of course, in 97 were exempt for shareholders, which was actually a nice thing. Then in 2002, in 1999, tax at long-term capital gain was capped at 10%. So Mr. Yashwant Sinha actually brought in the change. So the government changed for a small period of time, and BJP changed the regime to 10%. Uh, and the option was given 20% with indexation or 10% without indexation. That was the option given for stocks. STCG was kept at slab rate, dividend was exempted for shareholders. So the only change was made in long-term capital gain. Then in 2002, again dividends was taxed in the hand of shareholders, again by Yashwant Sinha only. And LTCG was changed 20% with indexation or 10% without indexation. That remained the same from 1999. Everything else remained the same. Then in 2003, Mr. Jaswant Singh became the FM, and he reverted back to tax-free status for dividends earned by shareholders. So dividend has been the main point of contention amongst all these finance ministers. LTCG kept the same, STG kept the same. And in 2004, when Mr. Chidambaram came back to the finance ministry after BJP was thrown out, uh, he exempted long-term capital gains. So remember, he was the one who brought in, the 20% with indexation, the party. But here they have exempted totally long-term capital gains. Uh, Small short-term capital gain for the first time was introduced at 10%. So which was going at slab rate has now been brought to 10%, and all this was done with the promise that we are doing this because we are bringing in another tax called securities transaction tax, and because we are reducing tax on one side of long-term capital gain and short-term capital gain, we are going to charge STT on the other side, and this should not be a problem to anybody. And people loved it because at that point of time, the STT, if you were doing FNO transactions showing business income, STT was seen as advanced tax, and you were able to set that off against your tax liabilities. Later, uh, in 2008, STCG was increased from 10% to 15%. Long-term capital gain remained exempt. Dividends remained exempt. But STT was gradually increased. In 2016, in BJP government, Arun Jaitley was the FM. He kept everything else same, but he said there should be a cap on the amount of dividend if you're getting. So 10 lakhs and above, if you get dividend, then you pay 10%. And rest is the same. LTCG remained the same. STCG remained 15% same. Then in 2018, Arun Jaitley brought about the long-term capital gain tax again. So from zero, then again 10% on long-term capital gain. STCG remained at 15%. Dividend remained at 10% for dividends more than 10 lakhs. In 2020, Madam Sitaram made dividend taxable in the hands of shareholders at slab rate. So this was extremely harsh at that point of time. LTCG and STCG was not changed at that time. And now come 2024, LTCG is now 12.5%, STCG is now 20%. Dividends are taxed in the hands of shareholders. FNO, STT has been increased. So if you see this entire saga of last almost 32 years, we have just been doing flip flop of the tax policy. I mean, this is actually a joke. Why should a country have, you know, finance minister dependent tax laws? Every time a finance minister changes or he comes in a new season, or he or she, they make the change in capital gains, or dividend distribution or dividend receiving. I mean, this is actually, if you see that entire picture, because we see it once every 4 years, so the big changes, so we don't really realize it, but we are just going, ping pong in within this framework of zero to slab rate on everything, which of course is I mean, to my mind, quite ludicrous. And I want to thank the Mint for offering this infographic, which we have used for this journey of the long-term capital gains tax. Now, also to get some context from other markets. So we are using the Zerodha Varsity source here. So holding period for LTCG in India, Australia, US is 1 year. And there are some countries where there is no concept of a holding period. So Japan, China, UK, Canada, there is no distinction between short-term capital gain and long-term capital gain. They are saying any capital gain is capital gain. How does it make a difference? If I bought today and sold 6 months later, or if I bought today and sold 13 months later, doesn't make me a long-term investor actually. So this is how the distribution of versus other countries are. So in India, of course, the rate is now 12.5% for long-term capital gain, with some 1.25 lakhs is exempt and only taxable after that, and dividends are taxed at slab rate. In Australia, capital gains are slab rate, but tax is only on 50% of capital gains. So you are in effect paying 50% of slab rate. In Canada, it is also slab rate. Tax is only on 50% of capital gains and up to $250,000. And then you pay on two-thirds of capital gains if you are making more than that. So richer people will pay more percentage of capital gains, and not so rich people will pay only up to 50% of capital gains. Um, and there are some the tax credits also that can be grossed up with that. China is exempt. Capital gains from shares on China stock markets are exempt. Tax on dividend is flat rate of 20%. Uh, in Japan, the rate is 20%, and it's flat. There is no exemption, there's no nothing. Singapore and UAE, of course, are no tax zones, so no tax, not applicable. You can do whatever you like. UK is 10% and 20%. So up to 3,000 pounds is exempted. Post that, there is some slab where tax is levied at 10%. If you have even more income than that, then you have a capital gain at 20%. So given this context of these countries, we are not so far out of the zone of the average tax being charged. So 12.5% with this exemption of 1.25 lakhs is not extremely draconian. Yes, because we've had 0 and we've also had 20. So in that context, you should also see that in 1992, we had 20% with indexation and today we have 12%. So over a period of 30 years, taxation has not gone up over long-term capital gain from that point of view. But yes, versus uh, 10 years back when it was 0, we've applied 12.5%. So there are times, and I'm not siding with any government or any political party, or I'm not giving that color to this at all. I am as I would say not so happy with what has happened in terms of continuous juggling of rates. But there should be a streamlined long-term plan that okay, this is where we are, and we are not going to touch it for the next 20 years, next 15 years, at least. And immediately after the FM said that we are doing this for simplification and for long-term equivalence of all asset classes. The next day, the secretary comes and says that this could be increased later. So there's this entire narrative within the government itself not being on the same lines is very, very disturbing. Uh, there are then other highest capital gains tax countries like Denmark charges 42%, Finland charges 34%. So we enjoy, we want free education and world class things, but just see the kind of rates that they are also paying. France can exceed 30%, Sweden 30%, Greece 15 to 45%, Ireland 33%, Spain 23%, Italy 26%, Portugal 28%, Austria 27.5%. So if we are going to be developed like these countries at some point of time, our rates will also reach there. So we are on that path, you can say. Today it may feel criminal to pay tax because we are not able to see that infrastructure around us or civic facilities. But these countries have achieved what they have. I mean, and they are having to tax. But on the other hand, I mean, there are so many countries, of course, which most of which are sort of tax havens. So Bahrain, Cayman Island, Bermuda, Bahamas, Monaco, Switzerland, New Zealand, Hong Kong, Singapore, Belgium. uh, so these don't tax on capital gains, but their other taxation could be much more. So it is not that for instance, Monaco is not is charging very low income tax rates, or Switzerland is charging very low income tax rate. Income tax is very, very high, but capital gains is not so high. So that is a choice of that country how they have structured their capital gains. And of course, I mean, we have only 1.5% of our population who is actually paying some tax. Yes, 3 or 4% are filing income tax returns, but they are just filing it. I mean, they're not paying any tax on it. So direct tax is coming only in from individuals of 1.5%, and those people will continue to be a bit squeezed. So I mean, in all, if you see, I mean, given the fact that uh, we've had history of 20% also for long-term capital gain and slab rate of STCG, uh, 30, 40 years later, for rates to be almost at half of that, or at least at 60, 70% point of that rate, it doesn't look so bad. But because this interim period was there where LTCG was 0, um, short-term capital gain was 10%. From that point of view, it feels a bit aggressive that tax is continuously increasing. But my personal peeve, if you ask me, is the fact that we brought in STT to remove some taxation, and then we increased STT and increased this taxation also. So that is something which is very, very unfair. But as a absolute number of 12.5% for long term, I don't think it is so bad that it is made out to be. Let me know your thoughts on this, and thank you for watching our channel. Thanks. Bye.